Hello, and my name is Keith Richards, and welcome to the ValueTrend Smart Money, Dumb Money video. And this is a weekly recap of a blog series that I do on our website at valuetrend.ca. By the way, I'm a portfolio manager and president and founder of ValueTrend Wealth Management. And what I'm going to do is share with you the highlights from my bi-weekly blog every week on this video series. So I'm going to start with the blog that I did on Tuesday, which is the second blog I wrote of the week. And normally I like to highlight the first blog, but I really want to set the tone here, which was an overall market indicator that I talked about on Tuesday. And we use something that measures the risk versus the reward potential. Remember, markets always have potential for risk and reward. So this is a quantitative indicator that tries to measure both the weighting of risk versus return at any given time. And just because you have a higher risk indication doesn't mean markets can't go up. And just because you have a lower risk, better reward potential situation doesn't mean markets can't go down. It's just a weighting of the two. So this is called my barometer, as I noted, and it's got many different factors, including trend and momentum and breadth indicators. What I want to do right now is share my screen and just show you one of the indicators that was signaling caution, and that was the smart money, dumb money screen. So this is an indicator that pits investor confidence by two groups. The smart money is considered smart because they're typically more successful investors. They're typically institutions, hedge fund managers, large pension fans, pension managers, I should say, pension plans. These are the money that tend to have better research, more control over their emotions, that kind of thing. And we're seeing that the confidence level differential is that smart money is less confident than dumb money, which is retail investors who tend to buy mutual funds and ETFs. So we track mutual fund ETF flow, that kind of thing. This is sentimenttrader.com. And it's a subscription service. So what I'm showing you is the screen off of my subscription service. I highly recommend this subscription. It's very cheap, and I think it can be very valuable for investors to get a feel on overall market sentiment. So you can see that whenever the confidence spread where retail investors were more aggressively bullish than, say, institutions like pension plans and hedge fund managers, where you'll see that the markets, it tends to be a leading indicator, but eventually the markets tend to sell off. You can see that was here. You can see that condition right here. We got more minor sell-offs. Of course, that was the COVID crash. You'll also notice that when smart money is more confident on a relative basis than dumb money, so to speak, retail investors, we get market bottoms. So you can see that here, here, some of them are bigger moves than others. You can see that definitely here. Smart money was much more confident here, but we're in a situation where markets, where these smart money investors, pension plans, and whatnot, are a little bit more cautious, or actually would say a lot more cautious than retail investors. But remember, this is a leading indicator. You can see that this is the same situation we were here, and it took several months before, it doesn't just happen overnight. You can see we were in that situation here. It took about a month or two. Same with here. That was a good couple of 3 months. So, you have to be cautious with this. It has been in that area for a while, and we have had minor corrections on these signals. It moved back into the neutral zone here. And we're in a bull trend. So just to be cognizant that the barometer, which did signal 5 out of 8, which is a relatively bullish reading, is still showing some signs that maybe we're setting up for a correction in the next number of months. I wouldn't get too wrapped up in that reading, but it's just something to be aware of. So that's one thing I wanted to talk about. The other thing I wanted to talk about was my first blog, which is on Monday, and that was on just the overall look of the commodities market. Somebody asked me for the overall commodity argument. And so I'm going to share the screen again, and I'm going to go right to the blog if I can do so. Just bear with me. I will go to back to the Smart Money Dumb Money, but I had highlighted my blog. So regular readers of my blog will know that back in the summer, we were like, actually early summer, we were kind of early on this move, but we were very pessimistic about the outlook for these super high PE ratioed FANG stocks like Amazon and Facebook and Netflix, you know, the stay inside stocks like Zoom and Peloton and whatnot. We thought they were way overvalued. So we pulled out of these stocks like June, and we were way early because those stocks continued to move up into about August, but then they basically all peaked around August. And we moved into the commodity space as well as some value stocks. So while our first half of the year we underperformed the markets, our second half we killed it, and it's because of our decision to move into commodities. Now it's not every commodity that's moved up, but this is the grand commodity index, the S&P CGSI commodity index, and you can see that on a relative basis, it's had a move off of a bottom. It's been in a big downtrend since 2008, but I feel that the commodity space still has, you can't probably read this number, but about 24% more upside on a grand basis, on a larger basis. And a lot of that will be driven, I think, by certain very overlooked commodities like oil. And of course, I've been on the metals and whatnot, which is what caused our portfolio to do relatively well in the past 3 or 4 months compared to the market. But I feel that there's more of that to come. And we're seeing that right now after the Georgia election shows the Democrats are going to have a stronghold. And of course, they're going to pump a lot of money into the system. And we can argue about that all we want, but it's generally not bad thing for the overall market, but it's particularly good for commodities because they are inflation hedging vehicles. So that's one of my arguments all along has been that you've got to buy reflation stocks, as they're called. So this can be gold, commodities, whatnot, and value as well, because value stocks are undervalued. So we're too cheap. So one of the arguments again behind inflation from a technical perspective, this is the U.S. government's inflation CPI tracker, and you can see that, you know, although it's been in a downtrend since 2008, it follows a very similar pattern you'll see as the commodity index. It too is breaking out, and again, I think it's, you know, you'll see inflation pick up, especially with all this money printing. So that is that's the highlights of this week. And I do want to remind you again, read the blog. It's at www.valuetrend.ca. You know, there's a comment section. You can comment, and it's kind of a community thing. So, you know, please do read it. The other thing I want to mention is that it's my conviction that investors who don't react to these changes like we did this year with the move out of the FANGs and whatnot, which I think, by the way, is going to last a while, especially with Biden in power, and into the more value and commodity-based stocks. If you're not prepared to rotate in this way, and if you don't think that your portfolio is structured or you have the ability to ride these trends, you might want to consider talking to us at ValueTrend, because we're pretty good at that. We're very cautious investors. Our objective is not to, you know, spank the market. It's more about preserving capital, but moving with these cycles. We think that we're in the tail end of a bull market. It could be another couple of years, maybe 5 years, but it's not, you know, it's already been going for close to 10. So we think that there's a few more years left in this bull market, but typically there's more rotation as markets get closer and closer to the end of their cycle in a mega bull market. So that's one of the things that we do well, and we're pretty good at identifying bear markets, as we did in the last major correction, 2008. So we're happy to meet with you confidentially if you do feel you would like to discuss your own portfolio needs. If you've been riding the wave on this bull, that's good. If you think you're prepared for cyclical rotation using the tools that we discuss on my blog, then great. But if you do feel you need some help, then you know, that's what we're in business for. So again, thank you very much for joining me here, and I'll be back next week. Thank you very much.